Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Tomorrow is going to be, or is expected to be rather, one of the most significant days in the stock market in, let's say, 2 years. Because 2 years ago, I did a video on how the Federal Reserve was going to cut interest rates, and now they are expected to raise them tomorrow, which is Wednesday, March 16th, 2022. So it is completely full circle. So in this video, we need to talk about how do interest rates impact you as a consumer? How do they impact you as an investor? What should you be doing? And how we got here in the first place. So let's take it all the way back. Right, so the Federal Reserve is basically they have what they call a dual mandate: keep unemployment low and make sure the economy runs. That's basically what they do. And one of the main tools, not the only tool, but the main tool that they use to do that is to adjust interest rates. Remember, interest rates are basically the cost of money. So if I am taking out a loan on a house, which is what I did during this time when interest rates were low, I had to pay an interest rate. So right now, they cut interest rates, or before tomorrow, or whenever you're watching this video, interest rates were low. They cut them. That made it less expensive. It made me more incentivized and more eager to buy now because rates were at a historic low. The cost of money was low. When you take out a loan, you have to pay for that. That payment is the interest rate. So what they do, when everything was down, when the market was crashing, when the economy was falling apart, they said, look, we need to do something to get people to spend money, to keep people at work, to stimulate the economy, to run money through the entire system. And that's basically what it was. So what they said was, hey, interest rates are here. We need to cut them to incentivize people to buy. So for example, I bought a house. Other people bought cars. And the reason why they did that is not only did the coronavirus happen, but remember exactly what happened. Take a step back, take 2 years back and remember exactly what happened. When that happened, we had plants that shut down, people were quarantining, we didn't have a vaccine, we didn't know what was going on. When all that stuff stopped, that's where we started to get the supply chain issues. When you don't have enough people to produce the goods, the chips, the computers, the cars, whatever it is, then you have less of them. And that automatically creates a supply and demand issue. That issue got big enough where we started to see inflation. And that's how we got to the inflation numbers that we see now. It's not necessarily related to increasing gas price. That's more of a Russia-Ukraine thing versus inflation in and of itself. But everything from chicken wings to phones to used cars especially, all of that stuff was set off by the virus, which then created a supply chain issue, which then created an inflation issue. That's how we got here. And now the Federal Reserve is saying, look, the way that we do this is we cut interest rates to spur the economy, to make things go forward. And when it gets too hot, which it is right now, we're seeing 30 or 40-year highs in inflation where stuff is way too high, including rent and, like I said, wings and even tacos. My taco truck is more expensive than what it was like 6 weeks ago, and that's not cool. But aside from that, what the Federal Reserve does is say, all right, well, things are a little too hot. Let's taper it back. Let me rise interest rates a little bit. Let me, make people think twice before taking out a loan on a mortgage on a home or auto loan or whatever it is. This is what we're going to do and slow things down. They're expected to raise interest rates multiple times this year. Tomorrow is expected to be the first. As a consumer, here's what generally happens. If you got a savings account, which you should, how much you put in there is totally up to you. 3 to 6 months is what I would recommend. But in either case, the money that you got in savings, that amount should rise. The amount that the bank pays you, the interest rate on that is expected to rise. It will not be immediate. There's usually a lag. Tomorrow they'll raise interest rates. It might be several weeks before you get an email from your bank saying, look, we're going to pay you a little bit more. They're raising rates by 1/4%, which is 0.25. It ain't going to be much, but it will be something. So that's number one. As a saver, you are rewarded. If you are someone who is borrowing, that ain't the best for you. Those loans are going to get more expensive. That means that trying to buy a home in this environment is going to be a little bit more expensive here pretty soon. Business loans, auto loans, private student loans, all of those things usually carry what is called a variable interest rate, which means it can change. And if rates go up, all of those rates are going up. They are basically saying, look, We're going to make this a little bit more expensive to slow things down and hopefully bring down inflation. That is what their job is to do, and that's what they're attempting to do by changing interest rates. As an investor, things get a little more complex. Generally speaking, and again, 2022 is not a general year because, again, the war in Ukraine is definitely going to impact this. That's the biggest reason as to why oil prices are rising. However, energy prices across the board had already started to rise the second half of last year anyway, so this has accelerated that. But in either case, as an investor, I actually wrote an entire article on this. You should go check it out at Business Insider. But aside from that, there are a few things. Generally speaking, when rates go up, the market tends to drop. That's how it generally goes. However, we've been talking about interest rates for quite a while, and I can't tell you what's going to happen tomorrow. The market can say, oh look, this is what we expected, and do nothing, or the market can say, oh look, it is what we thought it was, and the market takes off. It was up like 600 points or something like that earlier today. So yeah, right. But generally, there are a few areas that do quite well when interest rates go up, and then a few areas that don't do well. Usually, and you've seen this already, tech companies do not do well in a rising rate environment. This is usually because, I keep saying usually and generally a lot because not every company falls into this bucket, and you'll see why. But for example, Microsoft is down 20% this year, which is crazy. We're just in March, and it's already down 20%. It's Microsoft. They're not going anywhere. Nvidia is down almost 40% this year. Facebook is down 50%. It's not what anyone would have expected. However, when you are a tech company, especially if you're new, a lot of times, not those companies don't really fall into this category, but in either case, what they do is try to grow as fast as they can. They borrow money and grow and grow and grow, and usually after a few years, sometimes like Amazon would take several years, they try and make a profit at that point in time. But if your company is unprofitable, you have to rely on debt. That means you need a loan, and those loans are becoming more expensive. So those stocks get punished the most. If you look at almost any tech company, you'll see like, eesh, it's real bad out here. It's real bad. In fact, I think as of Monday, 374 of the S&P 500, the biggest 500 companies, were all in a negative, and the only sector that was positive at that point in time was oil stocks. That's how bad it was. And again, with the exception of oil stocks, the entire market could have been down. All 500 of them could have been down. So it is getting rough. It's been rough for a while. So we'll see what happens tomorrow. But again, tech companies don't tend to do well. What companies do? Financials. I've been saying it for forever. Capital One. The only reason I kept Capital One is because I expected rates to rise. And this is not, fortune teller. We've been knowing this and been talking about it for quite a while. In fact, Capital One this week, so far in the last 2 days, is already up 6%. Will it continue to rise? I don't know. We'll see. But generally, financial companies do well. Companies that pay solid dividends, which, healthcare companies usually slot into that. Defensive stocks usually slot into that. And also REITs, real estate investment trust, also fall into those categories. Those are stocks that tend to do well. That is not a guarantee because, again, we have an entire war that the stock market is watching closely. So that is the one asterisk that's not what was on the calendar when we started the year, not something that anyone would have predicted in this line of work. However, that is the general case. We'll see if that plays out in the rest of 2022. But that is what usually happens as the base case. That is the template of what happens when rates rise. Savings accounts go up. Loans, private student loans, mortgages, auto loans, business loans, the cost of all those things go up. We do this to slow down the economy, to slow down inflation, because right now we have way too much demand and not enough supply. How do we end up in the supply chain issue? Because we had the virus, and that stopped people from working, and then we had to reduce capacity going into certain places. Should the supply chain issue resolve itself, then that's going to help out the economy tremendously. That means Ford can produce more cars, so too can Tesla, and we'll kind of get back to the up and up. Interest rates don't really affect the supply chain per se, but that is another cog in the machine that is impacting the stock market. All right, so now you know what is going on with the Federal Reserve interest rate announcement, or the expected announcement that's supposed to happen tomorrow, because there's no guarantee. Can't tell the future, so I don't know. I'm not telling you buy this, buy that, because the market doesn't do this tomorrow. I don't know that. I can only tell you what history has told us. And if you have been watching the channel, if you have been subscribing, you made sure you had those notifications on, which you should have, then You know all this already. We've talked about REITs. We've talked about defensive stocks. We've talked about healthcare stocks. You're already in the right places if you've been subscribing. So you want to make sure that you do that as well. All right, that is it for me. I will talk to y'all tomorrow. We might talk about how the market goes, or you could just, ask a question, submit the question in the comments below, and I can talk about that. All right, that's it for me. I'll talk to y'all later. Bye.